Hey everyone, Anthony Venuto here with In Touch Mortgage Solutions, and today we're going to talk about how to save some money, some tips and tricks that you can use to help keep more money in your pocket, and what I'm doing to make sure that I hedge my bet on my variable rate mortgage and keep money in case interest rates go up. Stay tuned, you don't want to miss this. Once again, I want to take this opportunity to thank all our continued supporters and viewers of the channel, everyone taking the time out of their day to click on the video, watch our video. Don't forget, if you are, hit the share, like, and subscribe button so that we can get this video out to as many Canadians as possible and help the YouTube algorithm. Now, back to the video. With interest rates on the rise, the cost of goods and services getting more and more expensive, the cost of fuel and food, everything has gone up, including interest rates when it comes to your mortgage and the cost of home ownership. Obviously, affordability, savings, all these things are becoming very in focus right now as we start to see interest rates rise, fixed rate mortgages tipping over 4%, and some lenders already at 4.5%. As we see the bond market surge, we see variable rate mortgages that are priced a little bit more aggressively. However, the discounts are dwindling, and the Bank of Canada obviously indicating further interest rate hikes. It is important to understand your budget more now than ever. For many Canadians who maybe have just entered the mortgage marketplace or real estate market in the last few years, who have come out of historically low interest rates, it might find it a little bit more challenging to budget accordingly as the cost of goods and services and homeownership have increased. So what I want to discuss in this video is basically ways that you can save some money and some things you may want to consider. And if you stay tuned to the end, I will talk about things that I'm doing with my variable rate mortgage to help protect myself against rising interest rates in the future. So I want to start off with the conversation I had with a client that we basically had positioned them to refinance their existing mortgage. These clients, unfortunately, had run into a situation where one person was off work during the pandemic and the other one was on mat leave, and basically income had severely suffered, and they were resulting to credit cards and lines of credits to help keep them afloat in that time frame. Clients, unfortunately, weren't prepared with additional savings as a rainy day fund in order for a situation like this when it could occur. And we looked at the way that we can help them position them in the future. So by refinancing them, consolidating all their credit card debt that they were paying higher rates of interest at, even their finance on their vehicles that they were paying a huge amount of money on, even all those payments in combined were much higher than the rate of interest on their mortgage. Consolidating it into a 30-year amortization helped them, even at a slightly higher interest rate than they were currently at, kept $1,000 a month of cash flow back into their pocket. Now, in an interest rate environment where things are going up, as well as when things for cost of goods and services are going up, cost of fuel and housing and food and heating, all these things being more expensive, the clients were appreciative of the extra $1,000 they were able to keep aside. Above and beyond that, obviously the clients were also in a position where they wanted to better prepare as they were expecting their second child in the next 7 months. We wanted to align them with some additional cash flow. In the whole process, basically what we had done is the clients had reached out and said, "Ant, look, you saved us this much of money. Is there anything that you can help us with or take a look at from your experience level and see if there's ways that we can trim the fat?" What we were able to do is sort of highlight and sort of go through it with them and say, look, I see a lot of money going towards subscription services. I see a lot of money being utilized in, Skip and Uber. Can we talk about this? And, we started going through them, and they end up spending almost $100 a month in subscription services between Disney and Netflix and, Hulu and Crave and all these other providers, right? And I'm not trying to, plug these companies, but, you start looking at it and you start to see all the monthly expenses. And I said to them, is there any way that you can maybe cut back on, some of these providers because, you're spending $100 a month. And they said, oh, wow, they didn't even realize some of them were still active and they were still getting billed for them. So it just brought them into focus that there were certain things each month that they maybe weren't paying attention to, or they were just seeing because they're $15-20 a month. Those things sort of go through the wayside. You may not see them. One thing we also discussed is, look, that we said over the last few months, this is how much money you spent in Skip, the Dishes, and Uber. And they were shocked because, you order, you think, yeah, it's quick, it's easy. But, for some clients who are looking for ways to trim that fat, it was a good way for them to bring that back into focus. And that was something that we did. The clients really appreciated. One thing I noticed, and this may go for some of you out there watching, is, if you're in a situation where one person's able to work from home and, you have two vehicles, maybe cutting back down to one vehicle as the price of gas is going up. And maybe you can sell that vehicle for a little bit more than you paid for it right now. Obviously, that's something that you may consider. But one important thing was the client advised us, he drives his truck. So he had a pickup truck, and the wife had a, small import that was, very fuel efficient compared to his, V8. And I said, look, if you're driving the truck to work every day, why don't you, and your wife's car's at home, and you have baby seats in both vehicles, why don't you take the smaller vehicle to work? It might be more fuel efficient for you, and you can keep some extra money in the bank, especially with gas especially premium gas being at over $2 a liter, right? So, they appreciated those little bits, and those are some things that I advise some of my clients, and maybe something for you to consider. Let us know other ways that you can save in the comment section below, because that might be something that other Canadians might find attractive. Above and beyond that, so we talked about it with them. Now, obviously, the product that we put them in helped them also position for future, savings, and help them to avoid maybe getting into high consumer debt. So we're able to put them in with a product that was going to give them a line of credit component in the future. Obviously, at this particular point in time, based on the debt load, the income, and the qualification, we weren't able to give them a line of credit, but we were able to check a box with the Scotia Step product, for example, which I advise if you're looking at the Scotiabank Step product, have a mortgage broker put that together for you, as it is very important to be structured properly. But basically, when the client hits a certain threshold, they'll be able to access some of the funds that they've paid down towards their mortgage, so they don't necessarily have to revert to using higher 19 or 20% credit cards. They may be able to use, the prime on the line of credit component. Obviously, we don't want anybody to get into debt, but obviously with the future that they're expecting another child, things happen, but we want to better present them. So when the $1,000 that we were talking about that they're saving per month, I said, look, here's this newfound money for you, right? Like, obviously, it's money that you were previously paying, and now you're going to see that you have this extra $1,000, and mentality has it that you save this money, you get this money, you're going to spend that money. So I advised them, I said, maybe walk into your financial institution or talk to an investment advisor and open up an account where you can sort of pull maybe 500 of that and have it go directly into a different account. So that money can be utilized for a few things, either for your child, for vacation, for rentals, anything. That money, invest it if you wish, or put it just to the side. And that money can help you maybe in 5 years from now, if interest rates continue to rise, that, maybe you'll have that extra money there to put towards the mortgage, or when the mortgage renews, or annually, maybe dump that extra money into the mortgage. Whatever you see fit, if you put that money aside, it's going to give you that buffer so that you don't necessarily find yourself in the same situation. Now, talking about myself. So this is me and a variable rate mortgage holder, and maybe many Canadians find themselves in this situation, being a variable rate mortgage holder. And obviously with 50+% of new origination and mortgages being on the variable, a lot of clients might find themselves in a panic. The first thing that I say to my clients, as well as to myself, is to not overtly panic too much. Hopefully my scenario helps some Canadians, figure out a way to not panic if you're in a variable rate mortgage. Maybe you lock in, maybe you don't. Let me know in the comments. What I do with my mortgage is basically I look at the qualifying rate of 5.25%, and I sort of do the math and say, hey, look, I'm at 2.10%, and what I do is basically look at the spread. So what I'm going to do is actually put the link to our Canadian mortgage app, my mortgage app, in the description box below, so that you can basically play around with this on your own. See the Canadian mortgage app, all our information comes up. It's a great app, by the way. So click on the simple mortgage payment calculator, and you'll see I plugged in my mortgage amount. Now I play around with the rate. So I plug in my rate of 2.10%. It gives you my payment, and basically that's a 5-year variable. Now what you can do is basically say, look, what's the difference between my rate and the qualifying rate of 5.25%? And basically you see the payment change. So I look at that payment amount, I say it's about $666 and change. And basically I look at that amount. Now I can play around with the actual rates and see exactly, if I wanted to pretend that interest rates went up to 4.2, whatever the case is, you can do that. Obviously there's a refinance calculator. There's some great tools, pre-qualification, purchase calculator, stress test, land transfer tax calculators. So if you're looking to go out there and buy, shameless plug, download the app. But basically, when I look at that money, I look at the amount that I'm saving or the amount of money that I could be potentially paying, I should say, at 5.25% if the Bank of Canada does increase its interest rates that high, as opposed to where I am right now. And I look at that amount and I say, okay, much like I advise my clients about putting some money aside, having it basically pulled out, that's what I do with my money. I basically say, okay, look, it's 5.25%. Do a few things. I basically take that money and I put it away. I invest it so if interest rates rise, I can actually pay down my mortgage with those extra funds. So that money's coming out of that account. Another thing you can do as a Canadian who's in a variable rate mortgage, maybe you're on a monthly payment, maybe you're accelerated, biweekly. Maybe you want to expedite that. Maybe instead of being monthly, go to accelerated biweekly, as that will basically put more money towards your mortgage much more quickly, will hit the principal balance much faster. So that's another strategy that you can do. Obviously, with this particular mortgage, it's important to understand that I've opted for, the Scotia Step product myself. Obviously, as a mortgage professional, we have many, many options in the marketplace, but I found this product to be much more resilient to meet my demands. And obviously, I set it up properly in the best way possible to maximize on savings. So with this particular product, like many variable rate mortgages in Canada, it is adjustable in the sense that when the Bank of Canada increases its overnight rate, the lender therefore increases its prime rate, and my payments are basically impacted. So now my payments jump up. So I'm still comfortable where I am right now, and I've built myself in a buffer by saying if I was to lock in at, let's say, 4% or lock in at 5.25%, whatever the rate may be, I've already put aside that money for that increase, and I'm comfortable because that money is already coming out. Now, with, as I said, the Scotiabank products, important to understand that that isn't adjustable, so the payment changes with the Bank of Canada and Prime. There are certain mortgage holders that might have a variable with a fixed payment. Now, if that is you, just be very cautious to understand a few components about that. Although your payment does not move, which is great, your back end of your mortgage does get impacted as the policy rate rises and that bank increases its prime. More money will tip towards interest, I should say, and less towards principal. So it is important to understand those differences. And with some of those banks that have those fixed rate mortgage payments, it's important to understand that they have what's called a trigger rate. If your interest amount you pay on your mortgage goes up to that trigger rate, then it will trigger your payments to change automatically. So you're not necessarily protected unless it hits that trigger rate. I hope that's clear. So I'll recap it very quickly. You have fixed rate payments, back end of the mortgage, principal gets impacted, more money goes towards interest over the long run, and you're not making those payments where, let's say, for example, some banks like mine, where I actually pay that money up front, it doesn't change the duration of which I've set my amortization. So if I've set it for 25 years, I will still pay off that mortgage if everything goes well in that 25-year span, as opposed to the other mortgage that could hit a negative amortization. There's pros and cons to both products. Obviously, understanding what is best for you if you're planning on a variable rate mortgage, and understanding that is key. Obviously, we encourage everyone to download the app. If you have any questions, feel free to reach out to us here at In Touch Mortgage Solutions. Follow us on Instagram. Email us if you have any questions, but we'll leave it here. And we wish everyone a great Friday and even better weekend ahead. Hopefully we've helped you save some money and keep some more money in your pocket. If we did, don't forget to hit the share, like, and subscribe button. Hit that notification bell so you get notified every time we post a new video. But until next week, have a great weekend, and we'll see you next time.